The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A dose of reality for the tech trade or a reset for the next leg higher. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. Another quiet day of trading, relatively speaking, before some busy events.
The calm before the storm?
Absolutely. All right, let's take a look at where things stand right now. The Dow Industrials, another day of modest moves, down by 0.1% here. But of course, this belies the fact that the Magnificent Seven are having a brutal day, off 1.7%, with Nvidia the worst performer there. And of course, the S&P and Nasdaq under pressure as a result. The 10-year yield lower by 3 basis points as yields are moving lower because traders anticipate a rate cut in September. And of course, WTI down about 0.5%, dipping below $63 a barrel. Oil traders are pricing in easing Russian sanctions as the president pushes for Ukraine and Russia to meet in person to resolve the war. Romaine?
Right across the screen for equity markets, the Mag 7 down 1.7%, the Nasdaq down about 1.5%, testing its short-term moving averages to the downside, a repeat possibly of what we saw in early August amid elevated concern about elevated valuation. The seeds of this, though, they've actually been evident in the options market since last month. 22V research showing that the relative cost of hedging against a severe downturn in tech stocks versus a mild one, that's surging to a 3-year high just over the past 5 weeks alone. In fact, when you take a look at what Morgan Stanley had to say about it, they actually showed that large cap tech stocks are now the most under-owned by institutional investors since 2009 relative to their weighting in the S&P 500. But not everyone is convinced investors should be so nervous about big tech, which still remains the primary contributor to the S&P's profit growth.
The big spend right now is still in technology, so those stocks are at a premium valuation for a reason.
Of course, premium valuation doesn't necessarily guarantee premium returns. Run the Bloomberg EQRP function on your favorite tech stock and you'll see what I mean. Microsoft, for example, has an expected excess return over the risk-free benchmark treasury rate of just 5%. Now, that's a healthy compensation to be sure, but it's about half of the risk premium that it offered up just less than a decade ago.
Yeah, these are good things to keep in mind because, of course, positioning and relative valuations can explain a lot of the day-to-day moves, but you've got to have the fundamentals. And, of course, here we're talking about earnings to back up the longer-term gains. Now, as the S&P 500, which is the white line here, has scaled new heights for much of this year, except for this period between February and, let's say, June, we've seen analysts ratchet up earnings forecasts. And these green lines that track EPS upgrades, you could see that right now, that green box highlights how upgrades are now hovering at the highest since go all the way back to December of 2021. So does that set us up for continued gains, Romaine? Not clear.
Well, let's kick things off to the close here on this Tuesday afternoon with Sinead Colton Grant, Chief Investment Officer at BNY Wealth. And Sinead, I do want to start with market valuations. Now that pretty much the earnings season is over, I know we have Nvidia still out there, but you've seen most of what the S&P has to offer. And at least on an earnings basis, it seems very lopsided towards big tech. And I'm wondering if that is a ratification of the rally that we've had or maybe an indictment of it.
Well, you know what we say to our clients all the time, Romaine? You've got to focus on the fundamentals. And that's really where we come to with tech, because when you look at the margins in tech are so much higher than the rest of the S&P. You look at the top 8 names in the S&P, their margins are double the rest of the 492. And so, yes, valuations are higher. And by the way, I would not say let's not focus on Nvidia next week. We do still want to see that we're seeing the trend that we've seen with the other big tech names. But it's all about the fundamentals and those earnings expectations. When
you take a look at the fundamentals, what is the main risk? I guess if you see any, what is the main risk that you see to those fundamentals going forward?
Well, look, I mean, there's a huge element related to CapEx and overall tech spend. What's been fascinating over the last year or so is that even if firms have been cutting back on their tech spend, and this is in the broader industry rather than the tech sector itself, they are trimming more traditional spends, not their focus on AI, where they think they're going to see significant productivity benefits. So that's an element. Then we also have to think about rate cuts, right? We expect 2 rate cuts between now and the end of the year. We're expecting that we're going to see a little bit more certainty coming from Powell at the end of this week at Jackson Hole. But look, I mean, we could start to see much, much stronger data taking out the 2 rate cuts that are priced. And, you know, that's a little bit more of a headwind.
Okay, so we've got NVIDIA as a big catalyst next week. We've got big retail earnings coming out later on this week. And of course, we already heard from Home Depot. What are you thinking in terms of whether a rate cut will actually move the needle here for the consumer and what some of these retailers are anticipating?
Well, what's most important to remember about the consumer is we often talk about the consumer in aggregate, but really the experience of the wealthier consumer is very different than lower income households. And that's where rate cuts really matter, right? Where it's going to move the needle on mortgage rates, it's going to move the needle on auto loan rates, even credit card rates, right? So that is what helps bring more fluidity to the system. Because I think what we also haven't really thought about enough is the fact that we don't have the same transmission mechanism as we used to. And here's what I mean by that. Think about all of the households that have mortgage rates that are 3% or lower, right? Mm-hmm. The fact that rates are going up to, 4 or 5%, as they have been over the last couple of years, it doesn't impact them. Whereas lower income households, the parts of the market that are more exposed to rates, like small cap, they're having a tougher time. So look, I do think that real interest rates are probably a little bit too high for where the economy is right now.
So where do you want to be in terms of invested in equities? Which sectors do you want to be most exposed to? It sounds like technology is still where you want to stay invested.
Correct. So we like tech. We also like financials because we think it has exposure to not only the steepening yield curve, but also as we start to see more deregulation, more M&A activity coming through. We think that's a positive. But, we also like industrials and utilities. Industrials really poised to benefit from the healthy economy overall. And utilities, sometimes you think about them as a more stable, slightly boring sector. But, they're AI adjacent because of the impact of data centers, the energy consumption. And so some of those names that would have been a 4% yielder, that could tick up to about 7%. That starts to look pretty interesting.
A little bit later in this program, we're going to talk a little bit more about the competition for returns, the idea that you're still getting a pretty decent returns in the fixed income market, at least on a historical basis relative to stocks, and the idea that you don't necessarily have to go for the high growth, potential higher returns that you get in the equity market. You can look elsewhere and get something maybe not as high, but certainly something healthy. Do you buy into that?
Look, fixed income is an important part of a diversified portfolio, and we've now seen yields normalize, right? I think we have to say the decade of the 2010s was abnormal in terms of just how low yields were. But if you're thinking about a portfolio, you really want to think about what's your time horizon? Can you afford to take a little bit of illiquidity risk? Because when we think about allocations, we don't bifurcate between public and private, right? We want to think about publicly traded debt as well as private credit. On the equity side, it's public equities as well as private equity, venture capital, because that's really how you build a resilient portfolio over the long term.
How do you think about the political headlines that we get seemingly every day? For instance, the White House considering taking a 10% stake in the chipmaker Intel, AMD, and of course NVIDIA perhaps paying 15% of their China AI chip sales to the U.S. government. How do you fold that in?
So look, I think it's really important not to overreact to a headline, right? You need to understand the details of exactly what this means. So for example, when we think about the possibility that there could be more chip sales to China, first of all, that's good for the bottom line of those individual companies. But also, let's understand more what that means. Does it mean you get more of a handle on the black market in those chips that's developed, right? Are you able to better parameterize the national security concerns that are there too? So again, the details here are really, really important.
All right, Sinead, great stuff as always. Sinead Colton Grant, Chief Investment Officer at BNY Wealth, kicking us off to the close here on this Tuesday afternoon. And when we come back, we're going to revisit that research note by 22B and talk to the man who put it out. The disaster puts. Jeff Jacobson not necessarily anticipating a sell-off, but saying now might be the time to hedge for one.
That's quite the term, disaster puts. All right, while tech stocks are falling today, U.S. housing starts, they're rising. We're going to discuss the future of American real estate and the potential impact of a Fannie Mae Freddie Mac IPO with the former chairman and CEO of Fannie, Franklin Raines.
And from the outlook on housing to retail, we're going to talk about what to expect out of some of the big retailers set to report over the next few days, including Target. Stick with us. This is The Close on Bloomberg.
Analysts at at UBS raising their price target on gold to $3,700 by next March. The firm expecting Fed rate cuts and a weaker U.S. dollar to translate into gains for gold, which is already up almost 30% year to date. Our next guest runs a company aimed at keeping gold markets functioning through volatility. Joining us live right now is Josh Crumb, CEO of Abaxx, there we go, Technologies, which operates an exchange in Singapore that offers gold futures contracts. The firm also builds software for commodity trading. Josh, great to see you.
Hi, nice to be here. Thanks, Scarlett.
So have you recovered from the confusion 11 days ago when we were shocked, and of course certainly the gold industry was shocked, of that unexpected Trump administration ruling that certain gold bars would be tariffed?
It was a crazy day for sure, but it's actually why we built our business. So on one hand, a lot of our clients were kind of scrambling because this is now the third time in 5 years that the EFP, basically this price between LBMA and London and the COMEX price blew out, and that caused a lot of risk for people. But we built Abaxx to launch a kilobar contract in Singapore, very specifically because that's where the physical market lives. And so it was actually probably good news for us, but certainly our clients were scrambling.
There was a lot of scrambling, certainly. And you talk a little bit about, trying to bridge the gap between how gold is quoted and priced depending on what geography you're in. What is the appetite for something that kind of unifies across the different geographies?
Well, we're already seeing very good open interest in trading on our exchange. It only launched about 6 weeks ago for our gold contract. And we're really having a lot of Singapore and really all Southeast Asia rallying around our contract because it is the product that they're demanding, right? Because again, a lot of if you're buying gold over LBMA, that's really balance sheet gold. It's almost like foreign exchange markets. You're buying bilaterally with a bank. You're buying balance sheet gold. COMEX, of course, is physical, but it is kind of an older warehouse warrant system of older, 100-ounce bars mostly. But the main physical demand in the world is Asia for kilo bars. So, and that's what our market is kilo bars.
I am curious as to kind of where you think this market can go. We talk about gold right now, something like 33,000 an ounce, 3,300 an ounce, excuse me, in the spot market. You've seen forecasts, including today, UBS upping their price target to 3,600. We're already at record levels, more or less. And some of that certainly had to do with this administration and some of the policies coming in. If we start to get in leveling off of what's been happening in Washington, does that actually hurt the price of gold?
Well, again, I think physical demand has been very strong in Asia. There's a number of factors for that, but I think a lot of that even predates, some of the call it the volatility, policy volatility. Yeah. So I think, really we've been on a couple of years now, and it's really broken what used to be the old, when I was at Goldman, we always analyzed real interest rates as really the only factor. But now there's just a whole nother geopolitical bid from central banks that I think the market's still, even 2 years on, trying to get comfortable with what are the metrics to analyze that.
I am curious, though, about where exactly the demand is coming. There's been a lot of speculation, whether it's coming from governments, whether it's coming from traditional investors, whether it's coming from organized crime. There's been a lot of discussion about where those demand flows. Do you have any sort of clarity into where it's coming from?
Well, I think that's one of the other issues is it's not going through the typical, or not all of the flows is going through the typical way, again, buying from bullion banks in London, right? So even when the first movement started happening a couple of years ago, a lot of it was going through Dubai, a lot of it was going through Singapore, and not your traditional gold centers. And again, it's much more demand for physical rather than just having balance sheet gold, with a bank counterparty, for instance.
How has demand for gold in its different forms, whether it's physical gold or balance sheet gold, changed with the rise in demand for crypto?
I don't see it totally correlated. I mean, of course, after some of the political, policy changes around U.S. dollars, after Russia's invasion of the Ukraine, of course, that changed a lot of dynamics that probably affected both crypto and gold. But I really see them as very different markets. In fact, we still see crypto as very, correlated to, tech stocks and so forth, where gold really is, a physical safe haven that people look for.
There's been a lot of talk about more tokenization of assets. I mean, we talk about crypto and obviously the digital universe, but it's more than just sort of holding, whatever the digital currency is. There's this idea that the underlying technology can offer a way to sort of make all markets more efficient. How are you sort of diving into that, if at all, beyond just the commodities trade?
No, it's actually probably this.
Yeah.
There's two pillars of our company. It's why I started the business. One is to get commodity markets closer to physical, but second, to move collateral markets in real time. So my former colleague at Goldman Sachs, Allison Nathan, just put out a great report on stablecoins, like literally today. And there's a lot of talk about stablecoins for retail payments, retail holdings in emerging markets. But a far orders of magnitude larger use case is collateral, moving U.S. dollars in Asia or gold as collateral in Asia. And that's what you need for margins on, say, a futures trade. The Futures Industry Association actually just put out a great report about trying to move collateral to real time. And we really think we are going to be the first regulated clearinghouse in the world that will be able to do that with two upcoming pilots we're doing this year, moving tokenized money market funds in real time and moving gold in real time for collateral in Asia.
All right, Josh, great stuff. Got to leave it there. Josh Crumb there. He's the CEO of Abaxx as we keep an eye on gold prices, fractionally lower on the day, but still holding right around that 3,300 mark here on the day. We turn our attention back to equities and one of the biggest movers in the S&P today, and that is Home Depot. Actually seeing some improvement. We're going to catch up with Stephen Zaccone and get his thoughts on the most recent earnings report and what it reveals about the consumer. This is The Close on Bloomberg. All right, time now for our top calls, the big movers on the back of analyst recommendations. And we start off with Caterpillar. Evercore ISI out with a constructive view on the stock with an upgrade to outperform, a price target boost to 476, with the analyst citing the company's leverage and geographic advantage, and says Caterpillar is now in a position to actually scale back some of the discounts it's been offering, which should help boost the bottom line. The stock up for a second straight day. Next up, Prologis, Mizuho upgrading to outperform after being negative on the industrial REIT sector for 2 years now. The analysts seeing a better tactical setup in the current environment, particularly for Prologis, given its relative undervaluation and a more supportive macroeconomic environment. That stock having its best day since early April. And finally, let's take a look at Gap. Bank of America slashing its price target on the stock to 21, down from 25. It maintains a neutral, but the analysts raising some worries about tariff pressures, which could crimp the retailer's style heading into the quarter. Those shares fraction down about 1.3% on the day, and those are some of our top calls. We do want to stick with the consumer, and a big one, Home Depot. The shares up about 3% on the day after its earnings report this morning, and it reported relatively in line with results, with sales growth a standout as shoppers prioritize smaller projects. Let's bring in Citi Retailing Broadlines and Hardlines analyst Stephen Zaccone. He's got a buy rating and a $433 price target on the stock. All right, let's start off with the mix of sales that we saw in the quarter, because on one hand, I see there's a positive reaction in the stock. On the other hand, I would think that investors would be more enthused if people were spending on big ticket items rather than the more smaller scale projects. What did you make of the report, Stephen?
I think it's an encouraging trend. We've seen a year straight now where the homeowner has kind of engaged with smaller project activity. And, we're waiting for some of that large project activity to come back, but it's more so a function of rates, right? It's more so a function of the macro uncertainty, not necessarily something that's changed with the health of the consumer. Depot has kind of talked about the fact that that homeowner has been in a good place. They're just kind of pushing stuff to the right to wait for those rate cuts to come down.
Well, this gets to the idea, though, too. I mean, assuming we do get the rate cuts as the market is pricing in, I mean, what in your model is sort of the impact on the housing market and conversely on people going to Home Depot and starting new projects?
It's really a 2026 story, right? Because I think, the back half of this year is going to be modest improvement, right? I think when you think about the opportunity here with Home Depot, you've had 3 years of kind of weak same-store sales growth because we peaked during the pandemic. We've seen the homeowner kind of shift away to other categories, and now you have this deferral where you're waiting for them to come back. So I think the opportunity is this is really a 2026, 2027, earnings recovery story, right? And that's what the market is kind of anticipating. We've seen this environment where the stock has had somewhat of an elevated valuation relative to history, but it's really on the hope that the earnings recovery starts to materialize over the next couple of years.
All right, so some things are out of Home Depot's control, and it all depends on execution. When it comes to pricing, Stephen, what's the takeaway from the results? Are they maintaining prices, selectively raising? What should they be doing?
I think that was the incremental takeaway from this call, right? Last quarter, across retail, there was a very big focus on what retailers are going to say about pricing, right? The administration in Washington was watching. I think now we've seen the comment on the call from Home Depot was tariff rates are higher today than where they were in May. So that's probably going to result in some moderate price increases. Those haven't gone into effect yet in the second quarter, so they're more likely happening in the back half of the year. When you think about home improvement, that's a category where you typically can pass on price. You'll see some elasticity of demand, right? You'll see weaker transaction activity, but you're going to pass on that price because it's not really a promotional transaction. So prices are going to be up in the back half of the year. That is definitely a clear takeaway from today's call.
So Home Depot was the first big box retailer to report results this earnings season. We're of course going to be hearing from Target, Walmart on Thursday. How much can we extrapolate from Home Depot's results to those other retailers?
Yeah, I think the monthly progression of same-store sales growth is a good read because things clearly got better as the quarter progressed. The month of July was kind of the high point. They made a comment on the call that strength has kind of continued into August. It's hard, some of that is weather, right? We had a late arrival of kind of summer here in the northern part of the country. But it does seem like the consumers got a little bit more engagement. Hopefully we get some economic certainty. We get some more view from a geopolitical standpoint to get things kind of straightened out there from a geopolitical standpoint. But I think you're moving in the direction that the consumer is kind of hanging in there. It's been a choppy first half. There's been a lot of distractions with tariffs and stuff of that nature, but I think they're moving in the right direction.
We only have about a minute left, Stephen, but I do want to get your thoughts on Lowe's, which reports tomorrow. Are we going to see a similar pattern in their earnings report that we saw in Home Depot?
So the thing with Lowe's is I think you're going to see a slightly weaker same-store sales result. They probably saw the same sort of monthly progression. We have a buy rating on Home Depot. We have a neutral on Lowe's. My concern with Lowe's has just been they haven't made some of the investments to go after that large pro like Home Depot has done with the SRS acquisition and then the pending acquisition of GMS. So, Lowe's is much more exposed to kind of DIY and that smaller pro. I feel like you're better positioned in the home improvement arena with Home Depot.
Yeah, it sounds like Lowe's would be definitely a beneficiary of small projects, but also for consumers who are cutting back because of concern about the economy. CITI Broadlines, Retailing Broadlines and Hardlines analyst Stephen Zaccone joining us. Thank you so much. That, of course, was our top call on Home Depot. Coming up, excitement building around Fannie Mae and Freddie Mac as the U.S. government considers a dual IPO. We've got former Fannie Chairman and CEO Franklin Raines joining us next to break down the heightened interest and what a public debut could mean for these companies. This is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Scarlett Fu. We're not looking at a lot of active trading here in the market today, but there is some economic data to speak of. And if you're looking for encouragement on the economy, the housing starts would be pretty encouraging.
Yeah, it's somewhat encouraging. Can I push back on that?
Please.
Because we were just talking about Home Depot, and there's a positive reaction to those Home Depot earnings, but it was kind of weird. I mean, people aren't spending on big ticket items. They're spending on small ticket items. And I was having a hard time wrapping my head around why that should be a good thing long term. Similar story with the housing data we got this morning. You had something like housing starts up at like a 5-month high.
Yep.
Yet when you look at single family construction, that was soft. When you look at building permits, that was down. So what am I supposed to make of this?
Well, it is a recovery from the first part of the year where the home builders were very reluctant to add to more supply, right? You've got a lot of supply sitting out there and a lot of concern about affordability in general, whether it's for new construction, whether it's for existing homes.
Yeah, and affordability is a big issue. I mean, we're still talking about mortgage rates on average just below 7%. You're basically paying 6.5 to 7, and that's assuming you have decent credit. And this kind of harkens back to where we were. I mean, you go back to the early aughts when, mortgage rates were, 8-9% or so.
Yeah, so people are unwilling to move from their homes. The market is frozen in many ways, and I'm not sure that the data today changes that, although if you're looking for an up arrow, we did get that.
Yeah, we did.
All right, well, another story that we're watching in housing is the heightened focus on Fannie Mae and Freddie Mac. Shares of the mortgage financing companies up sharply since reports surfaced that the U.S. government is considering taking both public later this year. Of course, you have big investors racing to add their input. Bill Ackman, for instance, proposing a merger between the two, and hedge fund Edge One taking an activist stake. So let's get perspective from someone who knows the space well. Franklin Raines is former chairman and CEO of Fannie Mae, and he joins us now live. Franklin, thank you so much for speaking with us. As we mentioned, the president, no less, has been posting on social media a few times in recent months about a public offering of Fannie Mae and Freddie Mac and those shares. Do you think that such a move is necessary?
Well, it's been 17 years that Fannie Mae and Freddie Mac have been in conservatorship, and that's a long time, and it's probably long enough. What the only thing that's really changed in that period of time is we went from a consensus that Fannie and Freddie perhaps shouldn't exist to now a broad consensus that they should exist, and the only question is going forward in what form that will occur.
Well, you mentioned the conservatorship, and of course, both are still in conservatorship, and Treasury owns a sizable stake through its senior preferred shares. So I'm curious to hear from you what steps you think the administration would need to take to make these IPOs enticing to investors.
Well, I think you have to think more broadly than the IPO. That's one aspect of the transaction that's going to be necessary to move these entities into private ownership. That's one test, but it's not the only test. There will need to be accommodations across the board by all of the players. The Treasury with regard to funds that it believes it is owed, going forward, what the capital standards will be, and the consumer, whether or not the mortgages will become more affordable or less affordable as a result of these negotiations.
Well, there's also a big question too, Frank. And I mean, you know how this works. The idea that, the return on an investment, the return on equity that investors would demand is going to be a big factor in these discussions. And I don't even really understand, at least based on what we know publicly, what level they can even offer that would actually satisfy an investor base should they actually combine these companies into a new public entity.
Well, I think it'll be the standard approach to financial. It'll trade at a discount to the S&P average, as generally financials do, and a lot will depend in this particular case on the regulatory environment that the companies will face once they become private entities. One of the things, that I've learned in the 20-something years that I've been away from the company is that the most important aspect of looking to their future is, should they exist? And I think now there is a growing consensus that they should, and the terms under which they can exist, I think, will be negotiable between the parties, with the Treasury, the regulator, and the companies. I think you can put together a package that can be marketable. But will it be marketable with everybody getting everything they want? No. If the capital requirements are too high, it will not be acceptable to either the investors or homeowners. If the regulatory constraints are too tight, then no one's going to want to own the stock. But this is the way that conservatorships often are resolved, is by negotiation and concessions by parties to the transaction.
I mean, when you go back, Frank, to that day that a lot of us were shocked, of course, in the markets when we found out that the government was actually going to step in and take control of this. There was an idea at the time, and I went back and looked at those stories. I mean, that this would be a 1 or 2 year process, maybe at most. And now here we are, almost 2 decades later, more than a decade later. And it's raising the question, I guess, of why we need to even go back to any sort of structure with Fannie and Freddie. Can we have a functioning mortgage market, a functioning housing market without the GSEs and that implicit, if you will, guarantee by the government?
Well, I was shocked too. I was away from the company for 4 years at that point when they were put into conservatorship, and I was as shocked as anyone that the government did that. Secretary Paulson had promised to bring out his big bazooka, and he did. And we've been living with the consequences of that now for 17 years without a lot of progress toward having a better system than we had before. The U.S. has the most vibrant housing finance system in the world, and that's been true for many years now. Yeah. And that has allowed there to be great efficiencies in our financing, with mortgage to Treasury spreads being relatively tight through multiple cycles. Mm-hmm. And so it's a valuable system for the consumer. It's a valuable system for savings and investment, and it's one that has proven itself to be the most efficient way to provide housing finance. It's much more efficient than bank-dominated systems that we see elsewhere.
But what about on the risk side? I mean, you mentioned Hank Paulson and coming in with that bazooka. I mean, obviously the criticism at the time was that the underwriting standards were too lax, and that led to the perception of heightened risk with the GSEs and the potential for collapse. Were the standards too low? And if we sort of reincorporate these companies as one combined entity, I mean, what assurance will we have that the standards would be any different?
Well, I think the question wasn't so much the standards as the enforcement of the regulatory requirements. What happened prior to the collapse of the housing economy, was not that the GSEs had taken on dramatically greater risk, but that the private mortgage-backed securities market had done so, which then caused the GSEs to want to compete for market share. And this is the problem of financial regulation, whether it's the GSEs or banks, is that the regulator's responsibility is to not allow these market forces toward seeking greater margins or greater market share to override standards. That happened in the mortgage market, but it's happened about every 10 years in the general commercial banking market, where they have gotten seduced by the allure of rising margins and rising market share.
Franklin, as you mentioned, it's been 27 years since you've been in charge of Fannie Mae, and of course things have changed a lot. Bill Pulte, of course, appointed himself as director of both Fannie Mae and Freddie Mac. How unusual is it for the director of the FHFA to do that? And does it concern you, this arrangement?
Well, it's certainly unusual. He has a big job as the regulator, and to also be the chairman of the two companies, I'm sure keeps him busy all the time. But I think the important thing here is that as the regulator, as the conservator, he has the power of the board in any event, whether he's the chairman or not the chairman. So in many ways, I think it's more symbolic than real.
All right, Frank, really appreciate you taking time for us. Obviously, another topic that this market is really sort of hanging on, and it really gets to this idea of why it's taken this long. Frank Raines there, the former chair and CEO of Fannie Mae. All right, when we come back, we're going to continue the discussion about what's going on in the broader markets as we continue to count you down to the close, a refocus on tech stocks and a refocus on some concerns here that maybe it's time to hedge. Jeff Jacobson is the head of derivative strategy over at 22V Research, and he's got some interesting data here on just how much hedging is going on in that space. That's coming up next here on The Close. This is Bloomberg. All right, welcome back. 22V has an interesting report out today by Jeff Jacobson, a closer look at what options traders are doing, specifically when it comes to big tech stocks. The company is saying that traders are scooping up disaster puts on the triple Qs that tracks the NASDAQ 100 index to hedge against a potential sharp downturn in that group, of course, a group that has had a phenomenal run off of those lows back in April. Pleased to say that Jeff Jacobson joins us right now. He is the head of derivative strategy at 22V Research Group. As always, Jeff, great insights, great data. And let's just start off with what we're talking about. We're talking about a put skew, and maybe you can just put that into layman's terms, what that is and why it's at a 3-year high.
Sure. So basically, when we look at put skew, we're looking at how expensive are the tail or out of the money puts relative to the closer to the money puts. So in this case, for example, we're looking at the 10 delta puts in October relative to the 40 delta puts. And when I was looking at the skew, it was essentially at a 3.5-year high, meaning that the tail risk or the out of the money puts had gotten very expensive relative to owning at the money or closer to the money puts.
When you see this type of activity, and more importantly, this type of activity over a relatively short period of time, what do you read into that? What can you read into that?
Well, there's two ways to look at it. It's a combination, I think, of with the VIX having moved basically back to the lows, the closer to the money puts got cheap, and there was still a bid or people interested in buying the tail protection, possibly due to the after effects of the move we had lower in April and the tariff scare, or quite honestly, investors really concerned more about another event and less concerned about what I would say a normal pullback.
Concerned about another event. I mean, that could happen at any time. I'm wondering why now? Why are people putting on this position now? Is there a specific catalyst that could unleash in a disaster kind of scenario?
I don't think that. I think it's more of the NASDAQ had a 43% rally off the April lows. People have done very well. I think it's a combination of people don't know what that catalyst could be, but they want to have protection for that. And by doing so, you're going to buy the further out of the money, lower cost, but higher volatility puts. What I was trying to stress is I think the more normal pullbacks we've seen over the last 18 months, ex the tariff move, have been in that 12% range. So I wanted my clients to get ahead of that and embrace the fact that the tail puts are expensive, and to buy put spreads or even ratio put spreads where you have a better probability of making money on what I would say, again, a normal pullback.
Understood. Okay, so you've noted that traders are buying these disaster puts on the Qs, the ETF that tracks the NASDAQ 100. It's difficult to pin down why, because people do things for different reasons. But do you think this is specifically tied to technology companies, or is it a case of tech is just the biggest, most liquid part of the stock market, so it's an obvious place to start?
I think it's a combination too. Again, these stocks have done fabulously well off the lows. I think that there is a need or a want to protect a lot of those gains, and by doing so, you're going to kind of reach for the less expensive in terms of price, not volatility, by owning tail hedges. I think it's just a normal reaction when you've had such a sharp move off of where we were in April. And we have a lot of catalysts upcoming, whether Jackson Hole this week, we have the NVIDIA earnings next week, we have another payroll report. So I think it probably got to a point where people were like, thinking to themselves, we've made a lot of money, let's have some form of protection on. And rather than spending more in terms of nominal cost, they're more apt to buy the tail hedges as they've been doing.
I am curious, though, when we talk about some of the dating that we're seeing on this, of course, you mentioned some of those October pegs to that. And right now we're talking the Qs are right around just under 570, I think last time I checked here. So is the idea is to keep that hedge relatively tight? Or do you think, Jeff, there is a case to make that a little bit wider?
What's interesting about the hedge that I had described in my note to clients is buying the put spread, targeting that 515 level. That was at the time about 11% lower. It's a 200-day moving average for the NASDAQ, which I think should be a level of support. So initially, when looking at that spread, which was in terms of the triple Qs or NASDAQ, 10% wide, I think that's fine. I really don't think you need to go much wider. Again, the average decline ex the move we saw in April has been about 12%. So I think a 10% wide spread, but the key part being it started very close to the money, and now that hedge effectively is in the money already just on today's move. So it kind of reinforces my belief that you want to own closer to the money puts and sell the expensive puts that people are buying for tail hedges.
When you look at the data out there and what's been bought over the last few days and weeks, Jeff, do you have any sense as to whether this is broad-based buying, meaning it's several investors out there doing this, or is this just sort of a few big whales creating their own positions?
It's hard to tell. I think it's a combination, again, of people looking to just have that tail hedge on. Look, we've been through a period where there's been a lot of data points and just news flashes that have scared the market over the last, call it 6 months to a year. I think it's just after the move that we've had, I think it's broad-based that people were more likely or more wanting to own those tail hedges, and that's probably helped push the skew out to where it had gotten that expensive.
All right, Jeff, really appreciate your joining us today. Jeff Jacobson, head of derivative strategy at 22V Research Group. And Romain, we saw stock indexes hit their session lows at the top of this hour. We've come back off those levels, but we are looking at a decidedly lower stock market today.
Yeah, and it gets to the question, too. I mean, first of all, we have to put a grain of salt. Volume is low.
Yes.
Volume is light. And
Yes.
it always skews the price action just a little bit. But there is still a market that is kind of waiting to hear from Jay Powell on Friday. Everyone is sort of priced in this rate cut in September and maybe another rate cut later in the year. And the idea of whether Powell will either give a nod to that or throw cold water on it, or, as he'll most likely do, just dodge it altogether.
Yeah, throughout the entire speech, he won't commit to too much. I mean, we've certainly seen that in the past, although it's been pointed out that he has made headlines at previous Jackson Hole speeches that have really moved the market, especially the two-year yield. What's notable, even with the declines that we're seeing across the major indexes, is the S&P 500 equal-weighted index is actually up 0.3%. So a lot of the losses we're seeing are in the big-cap tech names, as we're discussing with Jeff Jacobson.
Yeah, and it'll be interesting to see whether some of the declines that we're seeing today is indeed sort of an about face, sort of the start of a more meaningful decline, or simply just a speed bump here in the road higher. Let's pose that question to our next guest. Darrell Cronk joins us right now to count you down to the closing bells, CIO for Wealth and Investment with Wells Fargo and Company and president of Wells Fargo Investment Institute. Darrell, great to see you here.
Thank you, Romain.
Do you have a favoritism right now when it comes to this debate between sort of big tech, large cap stocks relative to sort of mid caps, cyclicals, small caps? I mean, that's kind of the debate right now. Do you make that shift, or do you kind of stand pat?
So we absolutely do. We would say large and mid cap over small cap. We're unfavorable small cap here, even though you've seen a nice rally lately as everybody bets on kind of, call it early cycle dynamics, Fed cuts, all the things that can sometimes juice small caps. We would fade that completely. And then we still are favorable on technology. We still think you've got to go where growth resides. And there's just no doubt that that's where the growth is. You saw it in the latest second quarter earnings numbers. You take the 7 largest stocks, their earnings growth were 29%. If I take X those, earnings growth was like 3.5.
Yeah, absolutely. I understand the idea of chasing growth, but is there a trade out there that maybe combines growth with value, I guess, for lack of a better phrase?
Yeah, I think there is. And it's as you roll down kind of some of the cascading implications, whether it's the data center, builds and all that stuff. Actually, our single most favorite sector right now is financials. We still see the yield curve steepening from here, even though it's steepened already considerably. We still see an environment where you've probably got a Fed that's leaning more dovish, right, which should help financials over time. And balance sheets are strong. You're going to get the deregulation. So we still think that's an area where you're getting extremely good valuations, you're getting decent dividends, and it can make a lot of sense in today's environment.
Are you talking about big financials like the SIFIs, or are you talking about smaller financials which could see more prospect for consolidation?
I would still stay up in value, up in market cap there, Scarlett. I think you've got to stay where the strongest balance sheets are. They're the ones that are going to carry the biggest reserves. They're going to have the greatest dynamic to that yield curve steepening and net interest margin. On top of which, those are the firms that also own the big investment banks that benefit from a pickup in M&A and all the other stuff that's going on in the marketplace today.
So when it comes to earnings, we mentioned how they've been better than expected, and that's typically what happens. But NVIDIA could be the big one that really changes everything. Given what we heard from big tech, and it now feels like months ago, earlier in the earnings season, how's that shifted expectations for what NVIDIA would likely report next week? We
still think NVIDIA, the demand far outstrips what the capacity is to produce. So that's going to be great for margins, it's going to be great for earnings. It all depends on the bar of expectation, but I would think you'd see a decent beat out of NVIDIA next week, both probably on the top side and the bottom side. There's nothing to suggest otherwise in the demand that they get. And look, I mean, if you get, everybody knows the concentration of tech, right? If I get inside of comm services, 2 names, right? Google and Meta make up 53% of that index, and 3 names in the tech sector make up 51% of the index, right? So the skew, even inside of the sectors, the sectors themselves, not just the top 10 names of the S&P or tech as a percentage of S&P, is just abnormally high, right? Crazy high in today's world.
There was interesting data that came out today from Morgan Stanley that kind of talked about the idea that there are still a lot of institutional investors who are effectively underweight some of these big cap tech stocks, at least underweight relative to their portfolio weightings relative to the S&P weightings. I think one of the examples they used was Microsoft, which has a weighting of like 7% in the S&P, yet it's less than 5% in institutional portfolios. What do you think accounts for that discrepancy?
Some of it is the way that the asset managers are set up with what the rules and the concentration limits that they have within the actual funds themselves. But it's absolutely true. We see it across our platform. When we look at large cap growth, which should be where you get the biggest lean towards tech, the vast majority of managers are still underweight relative to even a benchmark weighting in technology and comm services, right? So that's been a drag on performance. It's fed into this narrative about active underperforming passive for periods of time. I mean, what people miss is since the April lows, we have lived on this rally back above the 20-day moving average almost the complete totality of the time, which is so rare for this duration of period that we've been going now from April to August, where that's happened. It's very unusual that you see that happen. And even as we sit here today, you've got the Dow, you've got the S&P, you've got the Russell 2000, all above their 20-day, above their 50-day, above their 200-day, right? It just keeps feeding onto itself, notwithstanding everybody's a little worried about climbing that wall of worry of all the things that could come at us in the fall.
You mentioned you expect a steepening yield curve. How do you want to be positioned when it comes to fixed income?
So it's interesting. Yesterday was the 11th month anniversary, so almost a year ago, when the Fed first cut interest rates on September 18th, 2024, right? Yeah. And if you owned long duration, you're negative today, right? So if you were out on the yield curve, you still show a negative rate of return. We've been actually barbelled right in the belly of the curve. Intermediates where we think the best value is. We've been unfavorable short, unfavorable long. It's interesting, if you look at really wealthy investors today, they're barbelled themselves, but what they're barbelled on is tech stocks on one side and cash or money market funds on the other, right?
Two extremes.
Yeah, and which is a little unusual. It's probably not where we'd be. We still think there's a nice roll down in the middle intermediate portion of the curve, and you can take advantage of that. But I guess if you feel comfortable with that dry powder and the cash side of it, nothing wrong with that either.
Is there a sense, though, too, just real quickly, only about a minute left, but if the Fed does indeed make good on what's on that dot plot with cutting rates, does medium-term duration somehow turn into maybe a better story with potentially shorter duration, or do you just kind of stay in the 5-year, the belly of the curve?
I'd still stay in the 5-year. I mean, look at the 2-year at 375, right? Fed funds is 433. Yeah. So you're a full, we've got two cuts priced in this year, 3 for next year. We think that's too much. We don't think the Fed can deliver again, just like the bond market's been job-owning the Fed for the past 2.5 years, and it's never come to fruition. We think they've priced in too many cuts today.
All right, Darrell, always great stuff. Darrell Cronk, president of the Wells Fargo Investment Institute, counting us down to the closing bells. Right across the screen for the major indices, though we should point out transports and mid-caps in the green.
Yeah, we heard Commerce Secretary Howard Lutnick talk about how he would be in favor, he would support consolidation among rail companies.
Yeah, okay, yeah, sure. Transports, we should point out, while everything is sort of testing those moving averages to the downside, transport's actually back above all of its key moving averages. The full breakdown of all of today's market action starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick here with Scarlet Food, taking you through to the closing bell with the global simulcast. It's already started. There's Tim Stenovec in the radio booth, Emily Guerfeo by his side. Carol Masser has the day off. Welcome to our audiences across our Bloomberg platforms here on a big test for the equity rally, Tim.
Yeah, I mean, a big test, but I think it's fair to say that the tech companies don't always go up, Romaine, and that's exactly what we're seeing today.
Wow.
That's what we're seeing with the NASDAQ Composite on the downside. Look at that, down 1.5%. The S&P 500 taking a hit down to the tune of 0.6%. It's being dragged down by mega cap tech companies.
Bitcoin also doesn't always go up. Try convincing the crypto fans of that. But we are seeing Bitcoin down about 3% right now, and Ether falling even more than that as well.
I know that was a lot of red arrows that Tim was just showing us, but within the S&P 500, 351 stocks rising, only 150 declining. So when you look at the S&P equal weighted index, it's notable that it is up about 0.3%.
Yeah, I like the glass half full thing there, Scarlett. And it also gets to this idea of Dow Transports up more than 1% on the day, with some of those transport stocks getting a bid. And I just want to point out, too, we talk about tech stocks being on the back foot. Not all tech stocks. You take a look at the NASDAQ 100, and the number one gainer there on a percentage basis, Intel, up 7%, of course, after yesterday's 4%.
That's a singular story, though.
Yeah,
I think it's fair to say. You're going to have to wait for my gainers to hear why.
Did I step on your toes?
If you haven't been staying tuned.
It's a deep tease.
What's Emily got? Can I step on her toes? All right, let's
Don't do it.
All right, let's walk you through the closing bells here in New York. A bit of a pullback for some of the major indices here on this Tuesday afternoon. Maybe just a little bit of profit taking, maybe a rethink of the rally, maybe concerns about valuations, or maybe concerns about the Fed. The Dow Jones Industrial Average is going to end the day relatively unchanged after spending a good portion of the day in the red. It's going to close higher by roughly about 7 points. The S&P 500 is down more than 30 points, or about 0.6%. The NASDAQ Composite down about 1.5% on the day. Similar move lower for the NASDAQ 100. And the Russell 2000 dropping about 18 points on the day, or 0.8%.
Hey, Scarlett, making a really good point earlier about the number of stocks higher in the S&P 500. It really speaks to the mega cap tech nature of these companies. That is, it is a market cap weighted index. We did have 356 stocks advance in the S&P, 146 on the downside, despite the fact that it closed down 0.6%.
Yeah, but when you look at the IMAP and you look at the size of the different sectors, there's a reason why the S&P 500 closed down, even though there's 7 sectors in the green and only 4 in the red. The ones that are in the red, tech, biggest sector in the S&P 500, right? A third of the S&P. Communication services makes up about 10% of the S&P 500. Consumer discretionary makes up 10.5%. Those are your leading decliners. And communication services and tech each down more than 1%. REITs, consumer staples, and utilities, some of your smaller sectors, they're leading the gains today.
Well, speaking of gains, I do want to start with Intel. Shares surging after SoftBank agreed to buy $2 billion of the company's stock, up 7% at the end of the day today. Analysts see this news as positive, but continue to see a number of questions surrounding the company's prospects. Commerce Secretary Howard Lutnick was on CNBC earlier today. He confirmed discussions between the U.S. and Intel for the government to take a stake in Intel, but he cast the plan as a bid to convert CHIPS and Science Act grants into equity. So, as Carol always says, the devil is in the details, and we'll wait to see those details. Also, Palo Alto Networks rising in today's trade. The company reported stronger than expected annual forecast. The company seeks to provide customers with a bundle of AI-enabled cybersecurity products to fend off attacks. Shares higher today by 3%. Palo Alto Networks CEO said, quote, "In this new era, security is no longer a bolt-on, and that an integrated best-to-beat platforms deliver superior security outcomes," according to him. And how about a little media merger news on this Tuesday? I'm watching what happened with shares of Tegna today, because Nexstar Media Group agreed to buy Tegna for $3.5 billion in an all-cash takeover. Investors certainly liked that, up 4.3% throughout the day today. The deal values Tegna at $22 a share, trading just shy of that, but it is a 44% premium to the company's stock price on August 8th, and including debt and transaction fees, it values Tegna at $6.2 billion, Emily.
All right, well, tech stocks were certainly amongst the biggest decliners of the day. Oracle was one of them that I chose to highlight. It fell about 6%. It was the biggest drop since April. Trading volume was also about 77% above the average for the time of the market close. We got news a few days ago that their longtime chief security officer, one of the highest ranking women in the cybersecurity industry, is leaving the company as part of a recent reorganization. Perhaps that's weighing on the shares a little bit today. Mary Ann Davidson, she joined Oracle in 1988. Additionally, when it comes to Oracle specific news, Bloomberg News recently reported that they're cutting jobs as the company takes steps to control costs amid heavy spending on AI infrastructure. So we talk a lot about this AI theme and spending, but here it is, maybe there was too much money and investors are taking note of that. I'm also watching shares of Viking Therapeutics. This was a big drop today after the company's experimental obesity pill disappointed investors in a mid-stage study. You look at the shares closing down 42%. Obviously, a lot of companies here racing to make those weight loss pills. Viking's pill did help patients lose up to 12.2% of their body weight, according to a statement from Viking, but almost a third of the patients dropped out of the trial in just 3 months. It seems like investors hanging on to that. And then finally, I finished with a company you guys may have heard of, NVIDIA. Trading volume was about 21% above the 20-day average. It was leading losses in the market today. And it was actually the biggest full-day drop since April 21st for this chip company. It was down almost 4%.
All right, and we should point out, too, not all the activity was in the equity market. We did see activity in treasuries coming off 3 straight days of actual price declines. We saw an increase in treasury prices across the curve, pushing yields down all across the curve, of just about 1 basis point on the short end and 3 basis points when you get out to your 10 and 30-year yields.
This may come as no surprise to our viewers and listeners who live in New Jersey. But New Jersey Transit, when you look at the other commuter rails in the tri-state area, including the Metro North and the Long Island Railroad, it's actually the worst in terms of reliability, and it's by a long shot. An analysis of real-time data shows that it's less reliable than the Metro North and Long Island Railroad, and riders face significant service disruptions at 6 times the rate of other commuters. Katie, Emily.
Wow.
1 in every 18 New Jersey Transit trains was delayed by at least 15 minutes.
Yeah, well, Katie's the New Jersey girl.
That's why
I'm the Connecticut girl. So this is kind of a win here for my state. For an average commuter, they had a bad commute roughly every 2 weeks versus once every 3 months or more if you're going to New York and Connecticut versus Katie going to New Jersey.
I feel bad because Carol should be here to defend her state. I mean, she's the New Jersey commuter. I know one of our producers commutes here from New Jersey and has to take the New Jersey Transit and is constantly texting us from wherever he's stuck, saying, it's going to be another hour, it's going to be another half hour. I'll get there when I get there. So I feel for them. I'm on the Metro North, which has got pretty good timely arrivals. But you take the subway, Romaine, right? You're good.
Me? No.
You don't even take the subway. He doesn't do public transit.
He's in a limo.
Do you even know me? Speaking of which, there are other stories out there, guys, and more important stories than your gripes about your pedestrian commutes there. Labubu is taking over the world, and now it's taking over the profitability of Pop Mart. Pop Mart actually just reported earnings, and its revenue jumped 200% year over year. Net income jumped 400% year over year. Of course, Pop Mart makes a lot of various dolls and trinkets and tokens, if you will, but nothing, at least in recent memory, has been as successful as the Labubu.
That is
Those
some
things
fat
scare me.
margins.
Yeah.
400% jump in net income, 200% jump in revenue.
Honestly,
but how long does this last?
I would have expected more.
Really?
No.
Yeah, that's it.
Okay.
What are the tariffs on these Labubu? Is Labubu the plural? Or do I say Labubus?
It's Labubai.
Labubai. Okay.
But it gets to this idea, too. I mean, we talk about these, how something that really has no value whatsoever to anyone.
That's just your opinion?
But it's just my opinion. But the way it just takes over, you see these things everywhere now. You can't even buy them. When they come onto market, scalpers just pick them up and, then they resell them for, 2-3 times what they paid here. This is the craze. Tim Stenovic?
Yeah, I heard you have an entire room in your apartment dedicated to just your Labubu collection.
I do. It's called the bathroom.
Is that true? I've actually only seen one of these, but maybe I'm just not looking up from my phone enough.
I can't wait for the crossover when we get the Labubu movie. The
Labubu video
Christmas
game.
I mean,
special,
look, we all know how this
games.
ends. We were around for the Beanie Babies, 25 years ago. So
yeah, I got a closet full of those.
Exactly.
Yeah.
All right. Well, that is going to do
Ask me
it
what
for our
those are.
cross-platform coverage
That's my
of
retirement
the
plan.
market close. You better have another plan in place, Romaine. We'll see you same time, same place tomorrow.
And our coverage continues here on Bloomberg Television. A closer look at the tech sell-off today and some questions going forward about whether that sell-off was even justified. We're going to talk to Dan Ives over at Wedbush when we come back. Stick with us. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Well, the close just happened about 11 minutes ago, and it was a down day for the major indices. The Dow unchanged on the day, the S&P down fractionally, but it was really big cap tech that really stole the show. The NASDAQ 100 dropping about 1.4% on the day. That bested some of the losses that we saw in the Russell 2000 and some of the other indices. The VIX slightly elevated and Bitcoin slightly down as well, down about 3%, raising some questions here about some of the risk appetite in the market. We should point out not all was lost here. NVIDIA did drop about 3.5% on the day, but of course we're talking about a stock that has been on a phenomenal run. But do keep an eye on some of the key technical measures here. NVIDIA closing below that 20-day moving average for the first time, I should say, since April. Meanwhile, Palantir on its longest losing streak, daily losing streak going back to March, erasing about 15% of its market value over that stretch, including a 9% drop on the day. But a few bright spots, idiosyncratic stories to be sure. Intel rallying about 7% after yesterday's sell-off. Some optimism here after we learned that SoftBank is taking a $2 billion stake in the company, and Palo Alto Networks rallying about 3% on the day on the back of a very encouraging earnings report. And that mixed bag that we just saw on this screen brings us to our top story, and that is the tech trade. Where is it? The S&P tech sector is still pacing the rest of the S&P 500 this year, and what is going to be the 11th year of outperformance in the past 12? That is the market. So we use that as an excuse to take a look back in history. Back in history at one of the key moments in the formation of this rally. August 19th, 2020, that was the day Apple's market capitalization passed $2 trillion, the first stock to ever surpass that level. And while it took 38 years to reach that first $1 trillion in value, that next $1 trillion only took 2 years. It was aided, of course, by the pandemic Selloff, that helped. But it also was aided by Tim Cook's management savvy and just a shift in the way investors were thinking about the company and the tech sector overall. Now, Apple's market value on this day in history, back in 2020, it almost matched the entire index of the Russell 2000 small cap stocks. And then back on this day, we saw so many headlines, so much hand-wringing about whether those valuations were justified. Headlines screaming that only 6 stocks were responsible collectively for most of the gains that we saw in the broader market for that year, up 40% as a group, just 6 stocks, while the S&P was down 4% when you exclude those 6 stocks. Not much has changed since. Apple now has a $3 trillion valuation. So too does Microsoft, and Nvidia, of course, is north of $4 trillion. And like in 2020, this broad market rally is anything, well, but broad. Just 5 stocks, all tech stocks, account for more than half of the market gains. 300 points of the 500 points added to the S&P so far this year. While the extreme concentration rivals the 1998 dot-com bubble, unlike 1998, those 5 stocks, along with 3 or 4 others to be sure, make up the lion's share of profit growth for the market as a whole. And maybe that's why some are betting that today's sell-off is just a mere bump in the road rather than some sort of wholesale about face. One of those folks, I think, not to put words in his mouth, is Dan Ives, a global head of technology research over at Wedbush. And Dan, I do want to start here with this idea that we've had, anytime you have a big rally, you're always going to have these daily pullbacks, even weekly pullbacks, if you will. That doesn't necessarily mean the rally is over. And I do wonder if you see enough fundamental case there for this rally to reset and continue.
Yeah, look, I view it as a bump in the road because it's our view, when you think about AI revolution, you're just continuing to get validation from earnings and from everything we see from the data center, as well as just overall demand. We'll see that from Godfather of AI, Jensen, NVIDIA, as we go into next week. And look, I continue to view this is a 1996 moment, not a 1999 or 2000 moment. And that's our view. I mean, this is a tech bull market that will continue to rage on in second half of the year into next year, given we're talking about a 4th industrial revolution that we're actually just living through.
When we talk about that 4th industrial revolution, everyone, of course, wants to know how that includes stocks other than, say, NVIDIA or Microsoft. I know we've talked about this before, the idea of the AI trade broadening. And it does appear investors are hungry for that, looking for who the next beneficiaries of this are going to be. Are they visible yet?
I think they're starting to be visible. I mean, we have our AI 30 list where we talk about the derivatives. It's not just, look, of course it's led by NVIDIA, it's led by Microsoft, it's led by, big tech, Meta and others, but now it's 2nd, 3rd, 4th derivatives. Nebius is a good example. You never would have talked about them a year ago. You look what's happening on cybersecurity. You never would have said it as an AI name, Palo Alto, CrowdStrike. You look on Palantir, 2 years ago, no one talked about it. A year ago, maybe, haters would talk about it. Look what's happened there. And the sell-off today, I just view as just a small bump the road to what I believe is $1 trillion market cap next 2 or 3 years. So my view is, and that was a great illustration what you talked about, it's going to spread. Second, third, fourth derivatives. And I always say, when the bears are in hibernation mode, they can see AI in the spreadsheets.
One thing that I found interesting about the rally, certainly this particular year that we've been in, is sort of the participation that we started to see amongst old tech companies. We talked a lot in the past on this program about Oracle. Today, we take a look at Intel, and I know Intel has a lot of issues. But to see not just so much the rally in the shares today, but the vote of confidence that Masayoshi Son and SoftBank had to put up $2 billion to invest in this company, do you think Intel is going to find a spot in this AI revolution, tech revolution, whatever you want to call it?
Look, I think the problem is they're just years behind, right? In terms of, you look at what Intel has done the last few years, has been just a massive black eye. Now, clearly, like SoftBank vote of confidence, obviously U.S. government, that's a little, call it obviously a champagne moment today. But I just think this is an Everest-like uphill battle. They're years behind other competitors when you look at NVIDIA, AMD, TSMC. And I just think, look, there's a better chance of me playing Ryder Cup Bethpage in September than Intel catching these other chip players, and that's the reality.
So what do you think Intel can be, or more importantly, what do you think it will end up being? Does it get bought? Does it get chopped up and into different pieces, or does it just kind of wither on the vine and go away?
I think chopped up. It's going to have to be strategically split. I mean, that's our view. Look, I get right now you're talking about one of the a core U.S. tech asset. You look at their customer base, but the reality is, like, market's telling you, I mean, of course you had today, but strategically that this is probably a company that's going to have to split up. I think that's part of the problem is that these tech companies, when you look at the ones that participate, they're so far ahead of the competition. And Intel, they've been on a treadmill almost, 2.5 speed or lower.
All right, Dan, always appreciate talking to us. Dan Ives, Global Head of Technology Research over at Wedbush, as we continue here on The Close with a focus on macro and a focus, of course, on Jay Powell, the Fed chair, set to give a speech at Jackson Hole, Wyoming. Later this week, we're going to break down what to expect. This is The Close on Bloomberg.
Chair Powell's in a tough spot going into Friday because we've got a long way to go until we have that September meeting you referenced, and a lot of data in between now and then. On top of that, he has the political pressure on the back of his neck he's been dealing with some time, so he can't lean one way or another, in my view, in this speech.
Rob Zaccone over at CITI speaking earlier on Bloomberg Television and warning that Jay Powell is in a tough position heading into that Jackson Hole summit this week. Our next guest coming up says that the Fed will stay on hold as much as it can. Economic uncertainty still high, so he says stay disciplined, stay invested, and more importantly, stay diversified. Those words coming from Omar Aguilar, the CEO and CIO at Schwab Asset Management, and Omar joins us right now. And Omar, I do want to start off with the Fed and the expectation for interest rate cuts. First of all, let's start off. What is your base case? Do we get not just that cut in September, but that second cut that was already modeled into the dot plot for 2025?
Yeah, I think the market seems to be completely into the cut, being in September. I think we have more than 80% probability that will happen. The second cut, in December is really more for our own view regarding the trends that we see in the economics, as well as just the trade-offs between what we see in unemployment as well as what we see on inflation. So the likelihood that we will see one or two cuts between now and the end of the year seems to be pretty high. The biggest challenge and the biggest question mark is whether or not you will do two cuts of 25 basis points, or they will actually try to accelerate and maybe just do 1 or 50 basis points. And a lot of those, will be probably, questions that may be answered, after the Jackson Hole meeting.
I am curious that, assuming we get those cuts, not only for this year, but of course the additional cuts that the market is pricing in for 2026, does that materially, in your view, change how you approach this market in terms of what you allocate to, what you hold on to, what you get rid of?
Excellent question. No, we have been very clear, and we have encouraged our clients here at Schwab that to continue to look at what we call the direction of travel. Try to stay focused on that long-term trend. It is a reality that between now and middle of next year, we will see lower interest rates. We understand the dynamics that go into the economic cycle, and we see the trends in the economy of a slowdown. When you look at the economic slowdown, when you see, yes, a sticky inflation that has been, putting these brakes into the Fed, cycle, obviously, we have to adjust to what the timing is and the volatility that comes with it. But the direction of travel is very clear. We will have a steeper yield curve. We will see lower interest on the low end, and we will potentially see a continuation of the rally of risky assets as, the market starts to go into the next phase of the economic cycle.
I want to talk about two pillars of that. Of course, what's going on in risk assets, but first, what's going on in the fixed income space. And when you look at yields and you factor in the expectations for a cut in Fed rates here, do you find, assuming you don't have a major allocation to fixed income, and I'm primarily talking about treasuries, do you go to the short end of the curve and take advantage of potential price appreciation? Do you lock in something on the longer end of the curve, or do you stay in the middle?
We have been, working on this premise just for the last few months to basically anticipate the potential, cut in Fed rates that will obviously be affecting the short part of the curve and the near-term part of the curve. So we encourage our clients to start increasing their duration to the middle size of the cycle. Again, the anticipation here is that we will have a steeper yield curve, and then trying to lock in those, yields that you have in the middle part of the curves with higher quality, it will be great. We have also encouraged clients to try to just be very cautious on how much credit exposure they have. At this point, the spreads are incredibly tight, and with the potential of economic slowdown, it is probably prudent to maintain that high levels of quality and don't necessarily go too far into the credit spectrum to try to generate more yields. So staying in the middle and try to take advantage of the yields that we have today until we see what happens after the Fed starts reducing their monetary policy.
With regards to equities, particularly given the elevated valuations, at least for certain pockets of the market, Omar, where are you kind of steering clients towards? Do you just say stick with big cap, stick with the big growth companies, or is there a broader trade out there to be had?
Yeah, the big part on the equity side is, your valuations are clearly above average. We have seen these trade-offs between, valuations being high, but at the same time seeing this incredibly acceleration of capital expenditures. The capital expenditure cycle was accelerated as a result of AI, but also as a result of the fiscal stimulus that was announced just a few months back. So when you put together that component, the whole story of what we've been working with clients is profitability, looking at margins, and looking at those companies that will be able to absorb any uncertainty on trade policy, that will be able to just stay competitive. So big part of the emphasis for investing over the next few months will be corporations that tend to be higher quality, corporations that tend to pay dividends, and corporations to be able to absorb uncertainty on the trade policy because they have plenty of margins. Industries and sectors and companies that tend to be more capital intense when they need to use capital, that will probably have a little harder time staying on there. So there will be dispersion and volatility coming from this.
All right, Omar, always smart. Always love talking to you. Omar Aguilar, who helps to run Schwab Asset Management, the CEO and CIO over there. When we come back, we are actually still awaiting earnings. Today, it's going to be Toll Brothers, the home builder. It's going to be an interesting report, particularly on the back of the actual official home building data, housing start data that we got earlier today. That conversation coming up after the break. This is Bloomberg. Some breaking news right now. This on Toll Brothers, the U.S. home builder, reporting earnings right now in the third quarter. The company did say that revenue came in at about $2.88 billion, just a smidge above the average of street estimates, which were looking for about $2.86 billion. EPS on a year-over-year basis, $3.73 versus $3.60 year-over-year. Not quite sure what the analyst estimate comparison is on that, but we should point out gross margin did expand just a little bit, 27.5, and home sales themselves in terms of actual unit sales came in the most recent quarter at 2,959, and that's higher than street estimates. They were looking for 2,927. The backlog, though, something to keep an eye on, coming in well below estimates. The company says that its 3Q backlog coming in about 5,492 homes. The street was looking for 5,720. You see the knee-jerk reaction here in the shares, down about 6%. We do want to talk a little bit more about the home sector with those earnings coming out here in the after-hours trade, and of course with those housing starts numbers that we got prior to the opening bell today. We want to bring in Orphe Divounguy. He's senior economist over at Zillow to talk a little bit more about the health of the home buyer market. And I am curious, Orphe, there's been a lot of talk about some of the shifts in mortgage rates as of late. I mean, I think we started the year roughly around 7%, the average mortgage rate in this country. That's down, depending on the data provider, maybe a half percentage point or so. And I am curious what more do we need to see to get a material increase in buyers coming off the sidelines and entering this market?
I think you nailed it, right? Affordability is still a problem, but it's actually been improving. Mortgage rates were lower than they were a year ago this home shopping season, but we saw sellers return, but we didn't see a big uptick in buying activity. And a lot of that had to do with the uncertainty that we saw in the spring, right? The big stock market correction in March and then in April. Look, the labor market is now showing, numbers that are kind of weaker, much weaker than previously anticipated. And the number one reason people move is for a job. And so when the labor market slows down and income growth remains somewhat subdued and people don't feel confident about their future income prospects, they tend to pull back, right? They sit on their wallets, they wait it out. And I think that's what kind of played out this spring.
I am curious. I mean, because obviously we talk here in the U.S., obviously a very seasonal industry with a lot of those sales weighted to the spring season. Now that we're basically almost through the summer and heading into the fall, are we going to see maybe a potential catch-up of what we didn't see in the spring, or do we have to wait until next year for the next spring cycle?
Yeah, it's interesting you say that. Look, buyers now have more leverage in negotiation, right? And part of that is the fact that there's not that many that can actually afford to transact in this market. The good news is we're seeing prices coming back down to earth in places where builders have been able to keep up with demand, and that has also contributed to the affordability improvement. Nationally, the share of listings with a price cut on Zillow was 27% in July, a record since we've been tracking this measure. Of course, there are huge disparities across the country. In the Sun Belt, we're seeing inventory accumulate. Part of that has been the big increase in supply coming from builders. In the Northeast, the constraint is still housing inventory. In the Northeast, we're not seeing the big increase in inventory. Inventory remains stubbornly low, especially around the tri-state area. Those are places where it's really tough for builders to lean into density. And so we're not seeing a lot of building activity there. And so price and rent growth remains relatively stubborn in that region. Are we going to see buyers take advantage of the affordability improvement? I think it's really going to depend on where the labor market goes from here. I think the emphasis on the Fed cutting interest rates, I don't expect a big move on the long end of the yield curve and mortgage rates, but I do expect, hopefully, the Fed to put more emphasis on the labor market slowdown. And if we see job creation kind of increase again and kind of move out of the stall speed that we're in right now, I think that buyers could come back, could slowly return to the housing market. Now, remember, last year we saw builders finish out the year pretty strong after those. Of course, we saw support coming from the Fed.
Absolutely. And I am curious. I mean, looking at Toll Brothers and really all the builders, I mean, we've heard them talk about this on past conference calls, the idea that they're actually trying to moderate a little bit of their growth to sort of match market conditions. And I am curious as to whether some of the moves that they made over the last few years, I don't want to say were wrong, but maybe they got a little bit too ahead of themselves with regards to some of their building.
No, if you look at where new construction is really strong, it's in the South, right? It's in those markets where, even as affordability, got stretched, builders really pivoted with market conditions. I think builders are still very good at predicting where housing demand is. And right now, what are they showing us? If you look at the latest numbers, they're showing us permitting activity down on a year-over-year basis, right? And so it's fewer homes that are going to get built in the months to come. So builders are already pulling back. So while I expect potentially that new home sales could finish out the year a little bit stronger, I think builder activity is going to continue to pull back, at least for the time being. Look, builders are facing higher labor costs. They're facing higher materials and components costs, and they're facing higher cost land costs. And so unless we lower builders' costs, builders are not going to be building into a easing price or even falling price environment.
I am curious on the affordability side, particularly when it comes to new homes. We did see builders offering a lot of incentives, particularly once mortgage rates spiked up, this idea of a way to get people in the door. A, did that help? And B, do you think we're going to see a rollback of some of those incentives now that maybe the potential pipeline of new supply might be a little bit more in balance?
So I don't think we're going to see a rollback. I think builders are kind of are meeting buyers where they're at, right? And in fact, the fact that mortgage rates have been declining since May actually makes the rate buy down a little bit cheaper from a builder standpoint. And so I don't think we're going to see a lot of that. However, I have to say that because the market conditions are such that buyers have more bargaining power, affordability is improving slightly, the fact that builders will begin to pull back means that potentially kind of this sweet spot that potential buyers are in right now may actually go away, right? If supply starts to pull back, you're going to start to get pressure again on prices. Remember, the nation is faced with a massive housing deficit. And so we need to keep builders in the game. And that means lowering costs for builders, especially in the current environment where they're kind of pulling back.
All right, Orphe, really great stuff. Orphe Divounguy is Zillow's senior economist here on a big day for a read on the housing market with those housing starts and building permits numbers that came out this morning. And here in the after hours trade, keeping an eye on Toll Brothers, the company, the home builder, just reporting earnings here. A miss on a couple of key metrics here. You see the shares slightly lower here in the after hours trade, down about 2%. Keep an eye on some of its peers like Lennar and KB Homes to see how they react in the after hours trade and maybe into tomorrow with regards to the cash session. But I do want to point out Lazy Boy. We haven't had a chance to talk about this. They did report just a little while ago, and the shares plunging here in the after hours trade after missing on several key metrics with shares, comp sales down about 4% in the most recent quarter, operating income down 32% in the most recent quarter, and the CFO talking in the statement about maybe some pressure on the consumer and its ability to continue spending. We'll be back in a moment. This is The Close on Bloomberg. A focus on the consumer this afternoon with recent economic data shielding consumers from the worst of tariffs. That's the read. But companies and economists alike are warning they are not yet in the clear. New data from the Kearney Consumer Institute shows shoppers becoming more selective with their purchases, toggling between the mindsets of scarcity, YOLO, and optimization. Katie Thomas is the lead at the Kearney Consumer Institute, a think tank housed under the global consulting firm Kearney, and she joins us right now to talk a little bit more about this data. Are we still spending money?
We are, and I know it seems hard to believe because you hear a lot about poor sentiment, high stress on behalf of consumers, but they are still spending for a couple of reasons. One is it's a sense of control. So consumers really feel like it's almost a reaction and response to all this uncertainty. I still have some level of control, and I'm shopping with intention. That's a word we're hearing a lot, intentionality, thoughtful trade-offs. But the other piece of it is just, because of all of this ambient anxiety, you kind of see them going back and forth from this okay, I'm going to be frugal, I'm going to show scarcity, be really thoughtful, and maybe not eat out all week, to, you know what, I give up, there's too much going on, I'm going to live my life, I'm going to book a trip. And so you're really seeing these dynamic mindsets impacting how they're spending.
I am curious. I mean, you guys have a report that's going to be published tomorrow. And one of the data points in there is this idea that the majority of folks are basically feeling the impact of inflation, particularly when it comes to their essentials, like food and other things. And I am curious, what type of impact does that have on their willingness to spend on discretionary items if they are feeling the pinch at the grocery store?
Yeah, I mean, they absolutely feel it the most on food, groceries, and then restaurants. But that's sort of an interesting dynamic because that's one where the price value equation has really gotten out of whack in recent years for consumers. And that's when you start to feed into, I don't love the term trading down to private label because consumers see it a lot more savvy than that. They're making good trade-offs. They're sometimes good enough is good enough. And that's what you see at the grocery store is I'm going to buy what feels like the right price value for me.
We just got several earnings from a lot of the publicly traded restaurant chains, Cava's and the Sweet Greens. Across the board, most of them were not very good.
Yeah.
And there seems to be under the hood this idea that people are dining out less, or if they are dining out, their checks are a lot smaller than what they would used to be.
Right.
Yeah.
So I would say it's a combination of the wallet tightening with this price value issue. So we did have about half of the consumers in the survey we're publishing tomorrow say they are trying to cut back on how much they eat out. However, when you think of some of those places you mentioned, bowls in particular, places that used to be $10 to $12 a bowl are now $20, and it really just doesn't feel like the quality's improved. The menus haven't been innovative, and so consumers are really questioning, is that even how I want to spend my money? So I don't think it's as simple as a trade down.
But there's inflation everywhere. I mean, you go out to a restaurant, you see it on the prices. Obviously, you see it at the grocery store. I mean, just today, my dog walker raised her fee $5, which I was like, oh, okay, sure. I mean, I have no choice but to pay it. But it gets to this idea that whether it's real or not, I mean, the idea is a perception. As you walk around, it seems like everything is significantly more than what it was a year ago or 5 years ago. So long term, does that alter the psychology of the consumer?
Absolutely. It's an idea called reference pricing, and it's just what you described. Eggs was another great example of that. It's like, I remember when eggs were $2, $3 a dozen, and it takes time for that to catch up. In general, there's going to be a consumer lag when you see this data, the impact of tariffs, and even right now, the job market is still reasonable. The labor market's healthy. You're not going to see this appear in consumer spending data overnight.
With regards to clothing, I saw that in the report, it was 57% bought new clothes or shoes.
Yep.
Is that normal? Is that sort of in line with historical averages? Or is that higher? What?
Yeah, I mean, it's about normal, but it's also not, I mean, that is a more discretionary purchase. You can kind of argue it either way. In some cases with kids, right, it's a little bit more of a necessity. But you're seeing consumers...
And for stylish adults.
Exactly, right. I mean, I certainly am still buying clothes and shoes. But no, you see, that's a great example of that, like, kind of retail therapy. I'm going to go to the mall. I'm going to do a little bit of shopping. I was at the mall this weekend. It was as hard to find a parking spot as it is around the holidays.
Really?
So back to school shopping certainly seems to be thriving.
All right. Well, this is a great report, and it kind of really gets to the idea just how layered our economy is, and it's not always just the aggregate, everything's bad or everything's good.
And how layered consumers are as well, yes.
Yeah, good point. All right, Katie Thomas is the lead over at the Kearney Consumer Institute, a new report coming out talking about some of the trends in shopping. And of course, this report comes on a week where we are going to get several earnings report out of several big retailers. That includes Target tomorrow, Lowe's, TJX, Estee Lauder among them, and that's followed by Walmart and Ross stores on Thursday. Here to discuss what to expect is Stacey Widlitz. She's the president and founder of SW Retail Advisors. Stacey, great to see you as always.
Good to see you.
I want to start with the big box stores, if you will, and we'll just start with Target for that matter here. Because this kind of straddles, I know people kind of look at Target as being discretionary, but to me it always felt kind of a in between. You know, it offers a lot of discretionary items, but a lot of necessities as well. And I am curious as to what your data and your research is showing with regards to how we're spending there.
Sure, and you're absolutely right. So, you know, Target definitely has less exposure to food than Walmart, but still, you know, a nice exposure around 40%. So they're definitely more of a discretionary play. But when you look at Target and think about it and look at the stock performance, you know, you have to understand that they've been losing share in the majority of their categories. So this is a self-inflicted story. We've certainly heard a ton about stores being in disarray, labor shortages, things being locked up so you can't access them. It feels like you're shopping in jail sometimes. So this is less of a consumer-specific story than I think a self-inflicted story. The good news is that the bar for Target is pretty low here going into earnings. But I think from an investment thesis, there are probably better places to put your money.
Yeah, obviously a very specific story to Target. And of course, a lot of questions right now surrounding the leadership there with Brian Cornell and his contract coming up at the end of this year. Turn to Walmart and specifically TJX, two companies, two retailers that seem to always defy whatever negative Nellies are out there with regards to consumer spending. Is this a function of their price value, or is this a function of their brand and marketing?
It's a very much, at the moment, a function of their price value. If you think about Walmart, where's the most of their comp growth been coming from? It's been coming from the higher end $100,000 plus consumer. So that's a share gain from other places. Certainly, they have the ability in a tariff environment when we are going to see more increases in pricing in Q4 and beyond, because you couldn't have loaded inventory from tariff announcements until holiday. So you're going to see some price increases there, and that's where the consumer is shifting. They're also doing a much better job in terms of advertising revenues, and certainly in general merchandise, they've become a lot better. So it's kind of like it's the perfect moment for Walmart. And also, if you think about TJX, they get all the overflow from the inventory that isn't selling in other places. And it's a treasure hunt. It's the price value treasure hunt for the consumer. And I would say, while we normally think of TJX, home goods is really the one where you're seeing the traffic, where we're seeing the biggest ramp, not only in the US, but also if you think about in Europe, there is TK Maxx, which is also gaining a lot of traction.
Yeah, and this is, of course, a stock certainly been loved by investors who are looking for something representative of the retail space. Can you talk more broadly about the retail industry, particularly as we head into kind of the final few months of the year? It's already back to school season. I actually did my back to school shopping last weekend. I know a lot of folks have already got it, and now we're already looking ahead to the holiday season as well. Are companies stocked up right now with the inventory that they need for this season? And more importantly, Stacey, how much should investors start to factor in tariff impact on some of those companies that maybe aren't as stocked up as they should be?
I think in general, back to school, we're seeing shelves stocked. We're not seeing companies that have said, okay, we didn't order anything because we're terrified of tariffs and the consumer isn't going to shop. We just didn't see that. As your last guest was talking about, the consumer is paying up for what they want. And I would say that in general, if you look at the apparel players out there, the majority X and American Eagle Outfitters that had an inventory blip, there's a lot of full price selling and mostly full price selling out there. And that's one way to wean the consumer off of these nonstop promotions. I think, and of course, move along price. I think one of the best examples of that is the Gap. We used to see 50% off everything for 5 days. Now we're seeing up to 50% off or shorter periods of time. So the consumer's kind of hunting for those bargains, whereas before they were more plentiful. But I think there's a decent amount of full price selling out there.
Yeah, and I'll just give a shameless plug here. A great story on the Bloomberg terminal today highlighting the CEO of J.Crew and some of the work she's done to turn around that brand and raise its image, along with a video interview there. When it comes to some of the more individual retailers, meaning not the multi-line retailers, so like take sort of a Crocs, basically a branded retailer here, are they in the same boat as the others, or is there something unique or special that we should be looking at when we start to get earnings out of them?
So I think if you look at all the brands and the ones that have reported, you have Tapestry, for example, that's Coach. You have Ralph Lauren. What they've done is during COVID, obviously there were shortages of inventory, so they raised their prices and again, reduced promotions. They have held the line on that, and they've been successful at that, and they've continued to grow their revenues despite the fact they're not offering things half price or 25% off all the time. So those are brands that have staying power. And, we're even seeing price increases being passed along at those. You're seeing others like Crocs that have significant wholesale exposure that are talking about, the wholesale channel all of a sudden is starting to push back and get a little scared and want to carry less inventory. So that's a story where, in some cases you want to look at brands and say, I prefer a DTC or direct to consumer story, one that has less exposure to wholesale when, the third party partners get nervous and pull back, which impacts your business.
All right, Stacey, got to leave it there. Great stuff as always. Stacey Widlitz is the president and founder over at SW Retail Advisors. We'll be back in a moment. This is Bloomberg. All right, let's push ahead to what the markets will have their eyes on over the next 24 hours. That includes a slew of earnings, particularly from some of those retailers we were just talking about. Target and Lowe's, as well as TJX, all set to report tomorrow. We're also expected to get reports out of Estee Lauder. And in the tech space, keep an eye on names like Baidu, as well as Analog Devices. We're also going to get several economic data points, but this time from overseas. UK CPI, a read on inflation there that is not expected to be good. Eurozone CPI over there that's also not expected to be good. And we are expected to hear from the president of the European Central Bank, Christine Lagarde. She's speaking at a World Economic Forum meeting in Geneva. Meanwhile, back here in the U.S., we are going to get those FOMC minutes from that July 30th meeting. And this could be key because, of course, those minutes will drop just a couple of days before Jay Powell is set to address folks at the Jackson Hole Symposium, maybe outline a path forward for the next set of rate cuts.